Every transaction we record has two sides, one debit and one credit. Over time, dozens or even hundreds of entries are posted into the ledger. But how do you make sure everything has been entered correctly? That's where the trial balance comes in. A trial balance is a list of all the balances in the general ledger at a particular date. It is one of the key checkpoints in bookkeeping, helping us confirm that our entries follow the double entry rules. The trial balance is generated to, first, provide an overview of all account balances. It shows the balance of every account, assets, liabilities, capital, equity, revenue, other income, expenses, and drawings, all in one place. Second, check mathematical accuracy. If total debits equal total credits, it suggests the arithmetic is correct. Third, help identify mistakes. If the totals do not agree, an error has likely occurred in the bookkeeping process. And fourth, prepare for financial statements. Businesses rely on an accurate trial balance to produce income statement, called profit and loss, and balance sheet, called statement of financial position. A trial balance acts like a bridge between the ledger and the financial statements. Before we build a trial balance, we must understand how ledger entries are created. This takes us to the duality principle. It's the rule that keeps our books balanced and is the heart of double entry bookkeeping. In accounting, every financial transaction is recorded using double entry, and all accounts fall into 5 main categories: assets, liabilities, capital and equity, expenses and revenue. These categories determine whether an item is debited or credited. The duality principle tells us that every transaction has two sides. To record these, we use double entry bookkeeping. One account is debited and one account is credited, and the total debits must always equal the total credits. Whether a debit or credit means an increase or decrease depends entirely on the type of account. Transactions can fall into 4 different duality patterns. First duality pattern is increase on both sides. For an example, the business buys equipment worth £2,000 on 30-day credit. Equipment, which is an asset, increases, debit £2,000. Trade payables, which is liability, increases, credit £2,000. Both sides of the accounting equation increase. An asset rises and a liability rises, but debits still equal credits. Second duality pattern is decrease on both sides. For an example, the business repays £500 of a bank loan. Bank, which is an asset, decreases, credit £500, and loan payable, which is liability, decreases, debit £500. So here we have both sides decreasing. The asset goes down because cash is paid, and the liability goes down because the loan is reduced. Third duality pattern is increase and decrease on the same side. For an example, business sells old equipment for £150. Bank, which is an asset, increases, debit £150, and equipment, which is an asset as well, decreases, credit £150. In this case, both entries sit under assets, so only one side of the accounting equation is affected. One asset rises, another falls, and the books still balance. And fourth duality pattern is increase on one side and decrease on the other. It happens when we pay for something or when money leaves one part of the business and becomes something else. For an example, business pays a rent expense of £300. Rent expense increases, debit £300, and bank, which is an asset, decreases, credit £300. By following the accounting equation and the debit-credit rules, we keep financial records accurate and balanced. Now let's practice how all of this looks in real accounts. We'll post the transactions into T accounts and then bring them together in a trial balance to check that everything adds up. Imagine we're looking at a few real documents, an invoice, a supplier bills, and some bank transactions. These are everyday business events. Our job is to turn them into accounting entries. The plan is, first, We'll take each transaction and decide which accounts it affects. Second, we'll record it into our T accounts. Third, we'll total everything up and check that our trial balance still balances. Basically, we're turning business paperwork into balanced numbers. Our first transaction, the owner puts £10,000 cash into the business. Which two accounts are involved? Bank and owner's capital. Let's post that in our T accounts. The bank increases, so we debit bank. Capital increases, so we credit capital. Next, the business takes out a £50,000 loan from the bank. That increases our bank, so debit bank. This increases our loan, which is liability account, credit loan. Then we buy computers for £9,600, including £1,600 VAT. So, debit computers £8,000, asset account. Debit VAT on purchases £1,600. And credit bank £9,600, asset account. We paid for our office supplies £500, so our double entry will be debit office supplies £500 because our expense increased, and credit bank £500 because our cash decreased. Office supplies is an expense, and expenses always increase on the debit side. The bank account is an asset, and assets decrease on the credit side when we spend money. Now, let's look at another transaction. The business received £2,000 for services we've provided, and the money went straight into the bank account. The bank account is an asset, and assets increase on the debit side when money comes in. The service revenue account represents our revenue, and revenue increases on the credit side. Debit bank £2,000 because cash in the bank increased, and credit revenue account £2,000 because our revenue increased. Let's look at this transaction. Our client has paid £5,400 for an invoice we issued earlier for software we provided. The money is received into our bank account. Our accounts receivable decreases because the customer has now paid what they owed. Assets decrease on the credit side. Our bank account increases because cash came in. Assets increase on the debit side. Let's look at the utilities and rent payments. Business paid £300 for utilities and £1,200 was paid for rent. Both reduce the bank balance, so they appear on the credit side. Utilities is an expense, and expenses always increase on the debit side. So the £300 payment is shown as a debit in the utilities account. The same applies to the rent account. Rent is also an expense, so the £1,200 payment is recorded as a debit in the rent account. This shows the double entry principle in action. Each transaction appears twice: a credit in the bank account and a debit in the relevant expense account. Now that we've posted our transactions into T accounts, let's bring everything together in one place. This table is the general journal. It shows every debit and credit from all the accounts we used. When we list all the debits and credits together like this, the total debits must equal the total credits. This is a quick way to check that our double entry work is correct. To make it clear, we'll use the bank account as our example, since it has several transactions and is ideal for showing the balancing process. First, we total both sides of the account, all the debits and all the credits. Then, we calculate the difference between them. The total on the debit side is £67,400 and the total on the credit side is £11,600. The difference between them is £55,800. It's the balance that needs to be entered into the bank account to make both sides equal. The difference is what we call the balance carried down. This is entered on the side with the smaller total, so that both sides equal the same amount. Finally, we bring that balance forward to the next period. This is the balance brought down. It appears on the opposite side to where the balance carried down was entered. If the balance brought down appears on the debit side, it means the account has a debit balance. In this case, the business has money in the bank. If it appears on the credit side, it would mean the account is overdrawn. Balancing accounts manually helps us check the accuracy of our entries before moving on to the trial balance, which summarises all our accounts at period end. Now that we've balanced the accounts, we can take the closing balances and record them in a trial balance. The trial balance shows all the account balances at a point in time. In this case, after we've balanced the bank account. Each account appears once, with its closing balance shown on either the debit or credit side, depending on the account type. The total of the debit column should always equal the total of the credit column. If they don't, it means there's likely an error somewhere in the entries or calculations. The trial balance acts as a check for accuracy, making sure that every transaction has been recorded with equal debits and credits. Although it gives a snapshot of the accounts, its main purpose is to confirm that the bookkeeping is mathematically correct before moving on to preparing financial statements. Now that we know how the trial balance is prepared, the next step is understanding what can go wrong. Before we can correct mistakes, we first need to understand the different types of errors that can occur in accounting records. First type of error is reversal of entries. This happens when the correct accounts are used, but the debit and credit are swapped. For an example, we bought equipment for £1,000. Correct entry should be debit equipment £1,000 and credit cash £1,000. But the wrong entry was posted as debit cash £1,000 and credit equipment £1,000. The accounts are correct, cash and equipment, but the sides are reversed. Why this matters? The trial balance still balances, which makes the error harder to detect. However, the financial statements are wrong because the accounts show the wrong direction of movement. We have to correct a reversal of entries error. The correction has two stages. Step 1. Remove or reverse the incorrect entry by simply doing the opposite. Debit equipment £1,000 and credit cash £1,000. This cancels out the mistake and returns both accounts to where they would have been if nothing had been posted. Step 2. Post the correct entry. Correct entry should be debit equipment £1,000 and credit cash £1,000. We do it in 2 steps because a reversal error means the original entry is backward, so we must undo what was done and record what should have been recorded. Removing the original mistake ensures the accounts reflect the true position. Second type of error is error of original entry. Error of original entry is when the wrong figure is recorded from the very beginning. An error of original entry happens when the correct accounts are used, but the amount itself is written incorrectly when the transaction is first entered in the books. This means the mistake starts at the source. For example, the invoice, receipt, or instruction was read incorrectly or mistyped. Once the wrong figure is entered, that same wrong figure gets posted throughout the accounting system. For an example, the business was meant to record £12,500, but the amount was mistakenly recorded as £1,250. The transaction is still between the correct accounts, but the value is wrong. Corrections follow a very logical process. Step 1. Reverse the incorrect entry. We post the opposite. Debit bank £1,250 and credit rent expenses £1,250. Step 2. Post the correct entry. Now enter the transaction with the right amount. Debit rent expenses £12,500 and credit bank £12,500. This 2-step method clears the books of the incorrect figure entirely. It makes the correction transparent and easy to audit. Next type of error is error of principal. When a transaction is posted to the wrong type or class of account, an error of principal occurs. The amount is correct, but it is posted to the wrong type of account. This breaks accounting principles. The trial balance still balances, but the financial statements become misleading. For an example, the business pays £400 for office stationery, like pens and paper, but the bookkeeper accidentally posted it as if the business had bought a new office desk, which is a non-current asset. Wrong entry was made, debit office furniture £400, which is a wrong type of account. The amount is correct. £400 was paid, but it was posted to the wrong category of account. To correct this error, we will remove the incorrect entry and post the correct entry. Since bank is correct, we don't reverse the whole entry. We simply credit office furniture £400 and debit stationery expense £400. Bank remains untouched because it was correct. We fixed only what was posted incorrectly. Next type of error is error of commission. Error of commission is when the entry is posted to the correct type of account, but to the wrong specific account within that category. The amount is correct. The debit and credit direction is correct, but the bookkeeper chooses the wrong actual account. Simple example: the business pays £150 for cleaning supplies. Correct expense account is cleaning expense, but the bookkeeper accidentally posts it to postage expense. Wrong entry made: debit postage expense £150, credit bank £150. Bank entry is correct. The only problem is the wrong expense account was used. We don't need to reverse the whole entry. We only fix the wrong expense account, credit postage expense and debit cleaning expense. Next type of error is error of omission. Error of omission is when a transaction is completely left out of the accounting records. Nothing is entered in any ledger. Because both debit and credit are missing, the trial balance still balances, making the error harder to detect. For an example, sales invoice omitted. A sales invoice is issued to a customer, ABC Limited. Net amount is £1,000, VAT £200, total is £1,200. Correct entry should have been debit trade receivables £1,200, credit sales £1,000, and credit VAT output £200, but the invoice was never entered in the accounts. This means ABC Limited shows no amount owed, sales are understated, VAT return is incorrect, profit is understated. How to correct an error of omission? Since nothing was entered, there is nothing to reverse. We simply need to post the correct entry in full, as if doing it for the first time. Debit trade receivables, £1,200, credit sales £1,000, credit VAT output £200. Another type of error is compensating error. A compensating error occurs when two separate errors happen in the accounts, but they offset each other, so the trial balance still balances. Individually, each error is wrong, but because one error increases or decreases the total on one side and another error increases or decreases the total on the opposite side by the same amount, the trial balance appears correct, even though the underlying accounts are not. These errors mask each other and make the books look right when they are not. Let's look at two unrelated errors. Error 1. Electricity expense was supposed to be £300, but the bookkeeper posted £200. The debit side is understated by £100. Error 2. Sales revenue was supposed to be £5,000, but only £4,900 was recorded. The credit side is understated by £100. Result of these, debit is £100 too low and credit is £100 too low. They cancel each other. Trial balance still agrees. To correct the understated electricity expense and sales, we debit electricity expense £100 and credit sales £100. Let's summarise the 6 types of errors that do not affect the trial balance. Even though these errors are all different, they have one important thing in common. The debits and credits still add up to the same total, which means the trial balance will still balance, even though the accounts are wrong. Error of omission. The whole transaction is simply missing. Nothing was posted at all. Error of commission. The right type of account was used, but the wrong specific account, such as choosing the wrong expense account. Error of principle. The transaction went to the wrong category of account, for example, treating an expense as an asset. Error of original entry. The correct accounts were used, but with the wrong amount. Reversal of entries. The accounts are correct, but the debit and credit have been posted on the wrong sides. Compensating errors. Two completely separate errors happen, but they cancel each other out, so the trial balance still balances. These are the key errors that don't impact the trial balance, which is why we can't rely on a balanced trial balance to mean everything is correct. A trial balance can agree, but the accounts may still contain mistakes. There are a few types of errors that affect the trial balance. These are older, manual bookkeeping errors. Modern systems normally prevent them, but you still need to recognize them because they explain why a suspense account may appear. A suspense account is used temporarily when the trial balance doesn't balance, holding the difference until the errors are found and corrected.